In this episode of the Joseph Carlson Show, we're going to be talking about stocks. We have a stock market that is rallying pretty hard. We have over the past week, the market going up over 3%. It's up over 6% year to date. And it continues to rally even to this day. Now, it's rallying so hard that even Michael Burry is capitulating. He tweeted out that he was wrong to sell. And now he seems to be broken a little bit. He's saying, going back to the 1920s, there has been no buy the effing dip generation like you. Congratulations. I think he's a little bit frustrated there that we buy the dip more than any other previous generation. Why is that? Maybe we have a better education and understanding about stocks, and we understand that typically over time, they recover. So investors are buying the dip. They're buying into broad indices, they're buying individual stocks, and our goal here today is to find companies that are still attractively valued, that are great quality companies. That's what we're trying to accomplish. And I have 5 different companies I'm going to be doing analysis on in this video. So having said that, let's go ahead and jump right in. Now, before we jump into these 5 companies, I first want to give a foundation of how I do analysis on stocks and the framework that I'm looking at. I'm trying to buy what I call compounding machines. Companies that have characteristics that enable them to grow their value, their intrinsic value, year after year after year. The way that I find these companies is unique in almost every single case. For example, we can look at one of the companies that I already have a large stake in. The company's in the restaurant category, and it is Texas Roadhouse, a company that sells steaks. Texas Roadhouse is one of the big winners in the portfolio currently. I'm up $10,500 on it. The company has widely outperformed the market. I was buying this company heavily into the 70s and 80s, and now it trades at above 107 per share. Now, how did I find Texas Roadhouse as a company? The story of this one is pretty simple. I've been going to Texas Roadhouse off and on. I've been visiting this restaurant maybe 2 or 3 times per year for about 10 years. Going way back to when I was in college, this was one of the fun restaurants to go to. Now, during that time period, even 10 years ago, I remember Texas Roadhouse always being busy. That was the problem with going to this restaurant. If you went to Chili's, it wasn't that busy. If you went to Olive Garden, it wasn't that busy. If you went to Texas Roadhouse, you had to wait. You had to wait in line for 20 to 30 minutes, sometimes up to 40 minutes, and that made it not even worth it. So a lot of times I ended up not going to this restaurant because of how consistently busy it was. Now, after 5 or 6 years, I started to get into investing. This also dawned on me as a positive characteristic for a company. Anytime a company has that busy of customer base, people waiting outside of the door to get their product, I look at that as a positive thing. And when I look at Texas Roadhouses now, across the country, they are typically more busy than any other restaurant. In most evenings, they're very busy. In most weekends, they're very busy. Even though they have a pretty good staff and they get you your food, they get you in and out of the restaurant pretty quickly, they still keep busy. And I've noticed that to this day, this restaurant stays busy. So this is how I got the idea, the initial impression to potentially look at Texas Roadhouse as a potential investment by visiting the actual restaurant. Once I noticed how busy this company was consistently with the 1 or 2 locations that I went to, I wanted to make sure those locations weren't simply outliers. I live close to a college town, so a lot of people visit this restaurant, and I assumed that it may be more busy than the average Texas Roadhouse. What I did to try to do a little bit more work on how busy all the restaurants are is I downloaded the mobile app. The mobile app allows you to get on a wait list. It allows you to pick the location and then to get on the wait list and to see how long the wait list is. What I started doing was looking at the wait list of every Texas Roadhouse across the country. I'd pick just at random, 1 or 2 of them in different states. It took only a couple minutes to do, and guess what I noticed? Every single Texas Roadhouse across the country were all busy. It was not just the one that I was close to. All of them were. I picked ones in different state after different state. Every single weekend, they have over 1 hour wait on their wait list. And you could do the same. You could download the app, you could plug in different addresses, and you can look at the wait time for each location. Look at the weekends. Every single weekend is consistently busy across different restaurants. So that's how I initially got interested in the company and looked at this as a potential investment. I looked at my locations, noticed how well ran the restaurants are, noticed how consistently busy they are, and then I also looked and took a pulse of the busyness of all the other restaurants, looking at the app and wait times. Once I was convinced that this restaurant had something that other restaurants did not, that they were operating on a better operating level, I decided to look at the company in terms of its fundamentals. That's when I go over to Qualtrim. I plug in the ticker symbol. I use this powerful tool to determine the long-term trends and operations of the company. And what do I see? A company that has a marvelous growth profile, incredibly consistent revenue growth, a company that has grown its free cash flow at above 15% per year, free cash flow per share at 16.3% per year, a company that's grown its dividend growth for 16% for 10 years straight, and it's accelerating its dividend growth. I was convinced that I found a decent company, one that is above others in its industry. And that's why I initially looked at this company as an investment. After that, you have to find a price point to buy the company at. Buying stocks in 2020 was easy. You could buy anything around this point and you would have done well, but it became much more difficult in 2021. I waited for Texas Roadhouse to trade down in share price just a little bit to get into an area where I thought there was a large margin of safety. That is right in this area, between $70 to $90 per share. That's where I was buying the company. At the time, it was trading for around a 17 forward PE ratio. Given the fundamentals of the company, I thought that gave me a good margin of safety. The company's growing much faster than the average company. The PE ratio is the same as the rest of the market, and it had no debt, and I thought very good growth prospects. At this time period, by the way, when the stock was going down, nothing changed negatively with its fundamentals. The restaurants were packed. I checked every single weekend consistently. I looked at the quarterly reports and they reflected the same. The weekly sales of the company went from $100,000 per week to $140,000 per week. As the price was going down, the fundamentals were improving. That's why I was so convinced to buy this company. And of course, given enough time, it's ran back up to $105 per share. As of right now, I am no longer buying Texas Roadhouse. It's up to a price that's closer to its intrinsic value. But that is an abbreviated story of the type of investments I'm looking at. Ones where I know that qualitatively they're very well ran. Ones where I know and understand the product they sell and the operations of the business. Ones that have very good fundamentals and trade at a discount to their intrinsic value. Once you find a company that has all of those stars align, everything line up perfectly, buying in heavily can lead to very good results. So that's what I'm looking to do when I do analysis on these different companies. And it's very difficult to find situations like this. So having said that, with that brief outlook there, let's go ahead and jump in to 5 different companies. Now let's go ahead and start off with Home Depot, a company we're all familiar with by now. Everybody knows Home Depot. I've actually had this company in the portfolio for a long period of time. This is one of the OGs to the passive income portfolio, but I've recently, as of the beginning of this year, consolidated my positions, sold out of Home Depot, and put that money into Costco. Now, let's go ahead and just take a look at the reasons that I did that. We'll review that, and then we'll do analysis on Home Depot and my current thoughts on it. First of all, the reason that I consolidated positions is because I wanted to have a more concentrated portfolio. A lot of investors, when they start off and they're a little bit newer and they're not as confident on doing investment analysis, they have a lot of positions. They simply just have many, many positions. When I started this portfolio, at one point in time, I had like 40 plus holdings. That's a lot of holdings. A lot of them were great companies. I had some weighted higher than others, but that's simply too many positions to manage if you want to have any type of concentration in your portfolio. So I've slowly, over time, been chopping down different positions and favoring the ones that I really like. This year, I made my portfolio slightly higher quality, and I favored the companies that I only have the absolute highest level of conviction on. I sold entirely out of Home Depot, which was a company that I've held since late 2017. Now, Home Depot is a company that I did sell at a pretty large gain. It was one of the better performing stocks during my time holding it. I held the company for around 4 years. I got a 50% gain plus the dividends on it, which is around 11% compound annual growth rate over that time period. So it was a decent holding. I made money on it, but I no longer hold the position. So first of all, let's start off with a quick look at the valuation. Home Depot is now selling at a 19.2 0.6 forward PE ratio. I'd say that's mid-range. I think the company normally trades between a 17 and around a 23. So you have a range of valuation there that this company typically trades at around 16 to 17, 23 to 24. Right now it's middle of the range. So based on the price to earnings, I don't think it's currently a steal. Based on the free cash flow, I think it looks attractive at a 4% free cash flow yield, but not necessarily a steal based on these metrics. Home Depot is a high quality compounder. It is a great company. Between it and Lowe's, it has a monopoly. They're kind of like duopolies with each other. It's similar to Visa and MasterCard. Home Depot's price is down 10%, while the S&P 500 is up 6% and the QQQ is up even more. So the differential between the year-to-date performance of Home Depot and the S&P 500 is 16%. That is a pretty wide gap. And that is when I love to pounce on these high quality companies. When their price is going down, the rest of the market's going up. That typically means that investors are becoming less positive sentiment on the company, and it probably has better upside. So this might give us some opportunity here. Looking at the overall revenue, we've seen this chart with Home Depot before. Of course, they had the Great Recession. I think that a recession of that magnitude, specifically with housing, is unlikely to have a repeat. So I don't suspect this to happen again. We might have some slowdowns in the economy that may hurt Home Depot, but not to this extent. Over the past 10 years, they've over doubled the revenue, and they've done that while keeping the same amount of locations. So they've just grown the sales and the ticket prices, and they have pricing power in their locations to grow the amount of sales without opening new Home Depots. That's a pretty incredible feat to accomplish. Right here, we're getting up to very high growth in revenue. And like we've seen with other companies, when they have abnormally quick growth, usually there's a little bit of a reversion to the mean. So we're seeing a little bit of that, and I think that's why investors are pricing it in. But an important thing to keep in mind with Home Depot is that not all of their revenue is tied to new home purchases. A lot of it is just tied to maintenance. If you own a house or a rental property, you have to maintain the place. Maintenance costs around 1% of the property value every single year. So people are constantly doing new improvements, new maintenance, fixing things, and for that, they use Home Depot. So I don't believe we're going to have too big of a reversion to the mean. I think that Home Depot and Lowe's still maintain a pretty healthy monopoly. I think they're going to figure out ways to grow revenue. Overall, I like the revenue growth. The revenue is converted into EBITDA. The charts look almost identical. When we look at the free cash flow of the company, I'll switch over to annual here. We have a couple different things we can look at with the free cash flow, but overall, if you're not familiar with what free cash flow is, I think it is the ultimate look at the profitability of the company. The best metric, in my opinion, is the free cash flow per share. So we look at the free cash flow here, and it's very consistent, very strong growth as well. We can see it going from around $2 billion back in 2008 to now being around $12 billion. Very strong growth in free cash flow. And another important thing to look at is that it's not really cyclical. After 2001, Home Depot really has consistent free cash flow. Very exciting to see a company do that. Whatever the economy's doing, whatever's going on, they print free cash flow. If you factor in stock-based comp, which in many cases makes the free cash flow dilutive and it makes it worse, Home Depot doesn't have that. They don't dilute shareholders. Their stock-based compensation is a tiny fraction of the free cash flow. Then we look at the free cash flow per share. This looks even better, which means that the company is currently doing share buybacks. So they're growing their free cash flow per share at a very attractive rate. Looking at the other profitability metrics, the net income looks equally as good. It's growing very quickly. Again, the big problem with Home Depot, looking at its historical performance, we look at the earnings per share. Very quick growth from the earnings per share. If I look at what's been happening in the latest quarters, I assume we're seeing a bit of a reversion, but we actually don't have much. The EPS continues to climb. This company is a high quality compounder. Now, if we look at the cash and debt of the company, this is the balance sheet. This is finally where we get to the point where I can say something I don't like about Home Depot, that they do not have more cash on hand than debt. This is what their cash looks like. They typically carry anywhere from $2 to $4 billion. Right now, they have $2.7 billion in cash. When we look at the long-term debt, they have $41 billion in long-term debt. If we look at the amount of EBITDA they did last year, they did $25.9 billion. So is this company in trouble with the amount of debt they have? No, they're not. They could pay off their debt with probably 2 to 3 years of EBITDA, which is in the category we want to see. Now we get to a big selling point of Home Depot. This has been a dividend growth monster. Over the past 10 years, they've compounded the dividend at 18.28%. One of the fastest dividend growing companies in the market over the past 10 years. And they have a long history of growing the dividend. The only time that it was really flat was again during the Great Recession. Outside of that, they're very committed to returning capital through dividend distribution. On top of paying dividends, they have a share count that's continually declining. This is what we want to see over time. This means the company's doing buybacks, increasing our equity in the company. So overall, I like Home Depot. I like where it's priced right now. I like the fact that it's trading down while the rest of the market's going up. I think that investors that are buying when sentiment's low on the company are probably going to do pretty well over the next 5 years. The territory where I'd really like to buy this company, where I'd really be looking at it, is when it gets down to the lower 16-15 forward PE ratio. Right now it's at a 20. That's again mid-range, but I'd like to buy the company where it's in its historical lower bound range. 14 to 15 forward PE ratio, that would really spark my interest. I think the future expected return would be higher. So as of right now, I'll keep Home Depot on the watch list. Now moving on from Home Depot, we have dividend payer number 2, which is MSCI. This is a company that I've been looking at recently. In fact, on my Patreon, on the Discord, I did a 1-hour exclusive analysis on this company. So I have recently looked at this one. And if you join the Patreon, you can view this 1-hour analysis on it. I go over the company in detail, but I want to go over some of the highlights of what I found. First of all, understanding MSCI's business. This company is an index company, similar to the S&P 500. You have $13.5 trillion in assets under management under MSCI indexes, meaning there's a lot of money that is linked to these indexes either through ETFs, hedge funds, or either benchmarked to this index. All of this money that's assets under management, MSCI earns a little fraction of it. They earn a little fraction every year as license agreements or royalties. So almost all of the money that they earn is reoccurring. In fact, 97% of their money is considered reoccurring revenue. So it's a very predictable company in the way that they earn money. They have an index, they have people use the index. That massive index makes it so that more and more people use the index, and there you have network effects. This makes it incredibly difficult to compete with this company. If you went out, for example, and created a new index and tried to compete with the MSCI index, you'd have a very difficult time. Even if you made your prices lower, even if you made your data better, you still probably would not be able to compete just because of the brand recognition and the already established scale of this index. The way to think about it is similar to the S&P 500 index. I own the company S&P Global, which is the owner of the S&P index and the Dow Jones. The network effects are so massive for the S&P 500 that it's used as the go-to benchmark of the market. When people talk about the stock market, they're talking about a product that company owns, the S&P 500. They also own the Dow Jones index, which is another lifelong benchmark that investors use for decades to benchmark their returns. So we have two major indices that have this brand recognition, that have these massive network effects. You can think of MSCI as the same thing, but basically in Europe. It's very popular outside of the US as a world index tracker. So I think they have an unassailable moat. I think it's too big to be destroyed at this point. There's so many things built off of their indices, 269,000 plus products, and then there's 1,300 ETFs built off of MSCI indices. Now, on top of that, they do other things. They provide market data and different things similar to FactSet or S&P Global, so they're in that nice data business as well. So what we have here is qualitatively a very high quality company. Then we look at the fundamentals of the company, and they look even better. Consistent revenue growth of around 10%, free cash flow growth of 14%, with almost no stock-based compensation. The free cash flow per share growth of an astounding 18% for the past 10 years. And then even more impressive, 28% for the past 5 years. That's one of the fastest free cash flow per share growths I've seen of any company ever. The net income looks incredible, compounding above 15% per year. The earnings per share likewise look incredible, compounding at an astounding 22% for the past decade. They've taken on some debt, and this is one of the downsides of the company. The balance sheet, they have $4.5 billion of debt and currently $1 billion of cash. But that debt is less than 3 times their last year's EBITDA, which means that they can manage the debt easily, especially with the quality of this business. The dividend growth is another thing that I'd like to point out here. For those of you looking for companies that don't necessarily have the highest yield, the company only has a current yield of 1%, but you're looking for companies that are growing the dividend at a rapid pace, this one has grown the dividend at a 29.4% compound annual growth rate over the past 5 years. Last year, they increased it by 32%. While they're growing the dividend, they're also doing an incredible amount of share buybacks. I believe this is what they've been using their debt for. They've reduced the amount of shares outstanding by over 3% in just the past year. When I look over MSCI, the metrics look phenomenal. The indice business is top notch. I think it has a moat that's almost unassailable. Probably as good of a moat as a companies like Google, Facebook, Amazon, or Apple. I think it's in that category, or maybe possibly even better of a moat than those companies. Over the past 10 years, MSCI has returned an astounding 1,500% returns. Obviously, that's not just market beating, that is multiples and multiples over what the market's returned. Over the past 5 years, 274% returns, not counting the dividend. And then just year to date, it's up 18%, beating both the S&P 500 and the NASDAQ. This company's just on a roll. It's been doing really well. It dipped for a little bit down into the $400 per share, where it wasn't necessarily cheap, but at least it was going down a bit in price, and investors quickly bought that up, and now it's back off to the races. Right now, the company trades at a 39 forward PE ratio, a 2.4 free cash flow yield. Even given the qualities of the company, the free cash flow growth, this is too expensive for my portfolio. I'm looking for companies that at the high end are trading at a 30 forward PE ratio, and hopefully somewhere in the low 20s. So MSCI is a phenomenal company. I'm going to keep this one on the watch list. I'll be looking at it. And if there's something that comes along that knocks down the price and makes the valuation more attractive, I'll be adding this one to the portfolio. But right now, simply too expensive. Now, next up, we have a hefty dividend payer, which is VICI. Now, I talk about this stock a lot. It's one of the ones in my portfolio. So I'm not going to repeat everything about this company. I have a lot of previous analysis on it that you can go back and watch. But I just want to mention why I continue to buy this company hand over fist over the past couple of weeks. Here's my recent history with VICI from my brokerage. We have right here the dividend payment back on July 7th of 2022, $445 in dividends. The dividend payment in October 6th, $486. The dividend payment January 5th, $493 in dividends. All the meantime, I'm buying up more and more shares of this company. I'm reinvesting these fat dividends back into the company, buying more and more shares. So with all that reinvestment and adding new money to this company, I've increased the holding position from being around $30,000 to $50,000 now, $9,100 in the green, and my next dividend payment is expected to be nearly $600, $597 to be exact. So this is a big holding, it's a big company. I think it's going to have capital appreciation. I think the company in and of itself will grow in value, but it also pays dividends at a very high yield. When I look at VICI, the company has been selling off over the past month. We had the price go down on a 1-month basis of around 6%, while the rest of the market's going up. A lot of investors are concerned of why VICI is selling off. When I compare this to the rest of the market, I do a very simple, straightforward comparison of VICI properties against VNQ, which is the Vanguard Real Estate Index, a market cap index of REITs, and I compare them year to date, and it's nearly identical. VICI is just trading right along with the broader real estate market. Now, VICI is different than the rest of these companies. VICI is unlike every other real estate company. It's not the same as any of them. First of all, VICI has better inflation-protected rents than almost any other company in that index, so it's going to have better rent coverage that way. Second of all, it has longer lease durations, much longer. On average, they're around 40 years. And then they also have less commoditized properties. Most real estate companies own properties that are residential real estate, commercial real estate, where companies are trying to work from home and minimize office space. They're trying to require less leases, less capex. VICI doesn't have to worry about any of that. Their customers cannot leave. They are trapped in those buildings. Now, something that I'd like to highlight on the subject of VICI, was a piece of content that I thought was just awesome. It's by the YouTube channel Neo, N-E-O, and it's called The Battle for Las Vegas. This goes over the entire history in a documentary-like perspective. And I wanted to highlight just one part from this video. This is the part relevant to VICI becoming the dominant player in Vegas.
The real trick, however, is that Caesars Entertainment was split into two completely separate companies. And this is how VICI Properties was born, a pure real estate company that would simply own the casinos. So while VICI Properties owns the land and buildings of the hotels and is less dependent on the fluctuations of the gambling business, Caesars Entertainment can focus entirely on operations and is lightened of assets. In addition, VICI Properties can benefit from a massive tax break due to the company being a real estate investment trust, also called REIT, which are exempt from federal income tax. A similar step also had been taken at MGM Resorts. And this is how MGM Grove Properties was formed, that owns the hotels and leases them back to MGM.
So that's a little segment from that video. I would check it out. I think it's a fun video to watch. But he highlights the breakdown there, that these companies do these leaseback operations where they sell their real estate to VICI, then they lease it back, and that's beneficial. It's a mutually beneficial situation to both companies. When I look at the potential threats to VICI and where I could actually lose money on this holding, it has to do with debt and it has to do with their tenants not being able to pay rent. The one that probably has the highest chance of having difficulty paying rent is Caesars. So when I do analysis on VICI, I'm doing analysis on Caesars, their tenant. When I do analysis on Caesars, I'm looking at the balance sheet and the cash flow of the company, and you can see that in recent history, the past couple of years, their debt is going down every single quarter. This is an intentional decision by the CEO. He is trying to de-risk the business by paying down over $1 billion worth of debt every single year. He's actually targeting a range of $1.3 billion of debt. So what we should see is Caesars become less risky of a company and a tenant over time, which makes VICI less risky of a company as well. Now, they're not directly linked. Even if Caesars could not pay rent, they'd have to find a new renter, it would be replaced by a different company, and VICI would probably still be able to collect some type of rent even in that scenario. But I think that's the most probable risk to causing problems with VICI Properties. I believe that VICI is a high quality company. I think the company is going to continue to compound for the next 5 years like it has. When I look at the 5-year chart, it goes right along with the intrinsic value of the company, compounding quite nicely above the rate of the market. This company has been a wildly market-beating return, and I think we'll see more of that in the future. Now, number 4, we're going to be looking at Intel once again. This is a stock that I've been following for a while now. I've never bought into this company. I've never actually pulled the trigger and bought any shares of it. I always have some things that hold me back. But Intel has gone through a very difficult time. The first thing I want to highlight is the price over the past couple of years. On a 2-year basis, Intel's down 49%. Company has really struggled, so it's been a tough one for value investors over the past 2 years. During this time period where the company was trading at $50 or even $60 per share, Intel still looked optically cheap because the PE ratio was very low. That's how some of these companies can be deceiving. Many companies with low PE ratios appearing cheap can get cheaper over time, unfortunately. Let's go ahead and take a look at what's actually happened with Intel. The big thing that's happened is it's had a bit of trouble in operations and execution. It's lost revenue and it's lost some customers. That's the reason that the company's gone down in value over the past 2 years. We can see the growth in revenue. This is 2010 right here. So from 2010, the revenue really hasn't gone anywhere. It's been flat the entire time. It was growing over the past 5 years, and then it completely got chopped back down to where it is today. So a decade long, no revenue growth. That's the first red flag, but that doesn't necessarily mean the company's at a bad valuation because right now the company traded down 50%. We can also look at the free cash flow of the company on an annual basis, and this also paints a picture of what's most concerning to investors. Most investors look at the recent history and the near future of a company. This is their area of studying a company. What happened over the past couple of years and what's going to happen this year and next year. What the PE ratio is based off of next year's earnings. When we look at the recent history of Intel, it paints the picture of a very good, fast-growing company. From 2017 to 2020, the free cash flow was going up, and then it took a tumble. And then it took another huge tumble, going widely into the negative for the first time in over 3 decades. So Intel is a company that's had trouble in its recent history, the past couple of years. But again, we don't really want to just look at the past couple of years. We want to study the long-term history of a company. That can be more informative. The biggest problem I have with Intel is the lack of growth over a very long period of time. For example, all the way back in 1996, the company was doing just over $5 billion in free cash flow. $5 billion in 1996. Then we fast forward to 2008. The company's doing the exact same amount of free cash flow. So we have there an entire decade, the company's doing the same amount of free cash flow. Then we look from 2008 to, let's say, 2021. We pick a mid-year here, and they're doing slightly more. They're doing just under $10 billion of free cash flow, so they grew it by double over a decade, but then it's starting to go negative, and we don't know where it's going to pan out. This isn't the fastest growth in free cash flow over that long of a period of time. I want companies that can grow their free cash flow by triple, quadruple over the next 10 or 20 years. Intel's has been mostly flat with some slight growth over time. Now we look at the earnings per share of the company long term. This is another thing where I like to look past 5 years. Again, most investors look at the recent history, what's happened in the past 5 years and what's going to happen next year and the year after that. This is their area of studying a company. What I really think is beneficial for investors to do is study the long-term history of a company, because that's very informative to how the company will trade in the future. It goes through different economic cycles, different recessions, and it shows the overall cyclicality of the company. What I see with Intel is a cyclical company. Growth from 1985 to 1988, and then a massive drop in its earnings per share. Then the earnings going back up to 2004, then them going back down in 2009, then the earnings suddenly speeding up, and then the earnings exploding in 2018, and then dropping off a cliff in 2022. My biggest problem with this earnings profile is I do not see predictability here. I don't think any investor has the foresight or the ability to accurately gauge what Intel's earnings are going to look like over the next 5 years. And as investors, we're trying to do discounted cash flows where we look at the earnings every single year. We try to predict what they're going to be. We try to buy companies where their intrinsic value is going up year after year. With Intel, that almost seems impossible. How can you predict the earnings of this company? We can look at other examples. I can show Costco and see what I mean by the differences in predictability of the earnings. Even Texas Roadhouse's earnings are much more predictable. Outside of the outlier of 2020 COVID lockdowns, the earnings are far more consistent, far less cyclical, and again, more predictable. Now, if a company doesn't have predictable earnings, that doesn't mean that it's worthless. It just means that you have to factor that into your decisions. I think for a company like Intel, you need a far bigger margin of safety than you would a company like Costco or MasterCard. You simply need to buy this type of company with a much greater level of concern and margin of safety. The cash and debt of the company actually looks decent. So a very good balance sheet. I don't think there's any problems there. And then we get to the dividend of the company. Now we know what it's going to be next quarter. They declared the next dividend, 13 cents. Right there. That's the most recent one. Notice how that's around 30% of what it was just a quarter ago, 37 cents. So what we have here is a dividend cut. The company cut the dividend last quarter. I thought it was a little bit unforthcoming from the CEO, the way that he did it. He did not say that they were going to cut the dividend when he was repeatedly pressed on it, and he kept referring to the dividend as healthy over and over again. I thought he should have just been more straightforward and said, look, we're looking at cutting the dividend. It is something that we're considering. He didn't say that, and they did end up just a month later cutting the dividend. If we go back to where it takes us, it's all the way back to 2007. So essentially, Intel is a company that has had no dividend growth since 2007, or over a decade. Not a strong dividend profile. That's a big red flag for the company. If we look at the shares outstanding, Intel has done buybacks historically. Using their cash flow to reduce the amount of shares outstanding is a positive thing for most companies, but we can see the trend reversing a little bit here as they're running into trouble. The past couple of years, the share count has increased by around 2% per year. Now, why have I not bought this company even though it trades at a lower multiple than almost any company I hold? This would be one of the seemingly cheaper companies in my portfolio, trading at a 15 forward PE ratio. The reason why is I think the company's too unpredictable, and I think the company also has a lot of operational risks. For example, if we look at the expenses here, this really shows you what this company's done over the past 5 years. The CapEx expenses have exploded all the way up to $25 billion. That's a massive amount of CapEx for a company the size of Intel, to have $25 billion in capital expenditures in a single year. It also requires a lot of research and development, and this is where we get to another risky part of the company. The company has an explosive amount of research and development. They have to hire very expensive teams of people to develop new chips. That's very difficult. They're competing with well-capitalized competitors like Apple that have other business lines that have higher profits so they can do this more effectively. Intel also spent not only $25 billion on CapEx, but they spent $17 billion on research and development. So that's the biggest reason why I've held off on this company. I don't like the risks associated with the business. I was critical of the CEO and how he communicated his dividend policy to CNBC, but I have to give him credit where credit is due. Pat Gelsinger has been buying up shares of this company left and right. He's been buying them up outside of his normal salary. So these are just market purchases of the company. He bought 9,700 shares at $25. He bought another 6,400 shares at $28. He bought 9,000 shares at $27.83. Now, I'm not saying that these buys from the CEO are evidence enough to go out and buy the stock, but this is an impressive amount of buys from a CEO. Most of them do one type of symbolic buy, a little bit of the company. He's not doing that. Pat Gelsinger has been consistently buying more and more of the company all the time. Almost every month he's buying more and more of it. And people sell stock for a lot of different reasons, for family planning, for financial reasons, but people typically only buy stock for one reason. They want to make money. So the CEO is putting his money where his mouth is. He does believe the company's undervalued. He thinks he can turn it around, and he has been buying the stock aggressively. Now, finally, we have number 5. A company that I've been looking at is UnitedHealth Group. This is the insurance company, which you may have had if you work in the US or any time in history, the United Healthcare Insurance. It's one of the biggest private health insurers in the country. They have over 26.6 million people served right in the US. They contract with a lot of companies, so if you work for a different company, you may have gotten it through your employer. Very large established health insurance business. Now, regardless of all the different problems that healthcare faces, this is a great company. Overall, looking at the fundamentals, it shows all the same characteristics you'd expect to see in a high-quality compounder. Long-term, sustainable revenue growth. You have EBITDA growth. You have free cash flow profile that looks very strong. Look at this free cash flow profile. Incredibly consistent and growing rapidly over the past 5 years, above 15% per year. Very low stock-based compensation. Dilution's not a problem for United Healthcare. And then the free cash flow per share growth, the key metric we're looking at here, is growing even faster. 15% per year for the past 10 years, which means this company's doing buybacks. The company's unlevered. They currently have more cash than debt, so they're not running any risk of leverage. They're a big long-term dividend payer since 1990. They've raised the dividend for the past 10 years at 22% per year, and the company's decreasing their share count ever so slightly over the past 10 years. So this company is a very high-quality compounder company. Why does it trade at a discount to other companies of this quality? It trades at a 21 forward PE ratio, a free cash flow yield of 5.3%. The reason being is because the ongoing risk of being in the medical industry and the potential for changes in legislation to have universal health care. And this is a company that's not doing so well this year. It's currently down 11%. The S&P 500 is up plus 6%. The Nasdaq's up above 10%. So we have a big disjoint in a high quality company, which could mean this is a good time to jump into the stock. What I expect to see with United Healthcare is similar to what we've seen in the past. Areas where it goes through a little bit of a breather, the stock price goes down for a bit. We saw the same in 2015. We saw the same in 2018. Company went through a little bit of a breather, but then we go through these long stretches of compounding, far faster than the market average. We've seen that happen over and over again with this company. Right now, we're in that rare timeline where the stock trades down. In hindsight, this is what every investor says they want. They want to find a quality company that's trading down or at least trading flat for a decent amount of time. And that's when they're going to pounce in and buy the stock. But when that happens, investors talk themselves out of buying the stock. That's why it trades down in the first place. There's some scary news or there's other companies that are better deals. We find ourselves in that same time period right now. The company's trading down. I think this one is a decent buy right now. So that's all the companies I'm looking at today. Let me know what you think. So far, I'm very happy with the results, the performance of the companies that I'm buying. So far, year to date, we're up 7%. I think this is a healthy return, and I expect more compounding in the future from these companies. So that's all for now. If you want more exclusive content, check out the Patreon and the Discord community. Other than that, I'll see you in the next one.